Welcome to today's deep dive. Today we're going to try to wrap our heads around this idea of the capital cycle, and we're going to use as our guide a book called Capital Returns, Investing Through the Capital Cycle by Edward Chancellor.
Okay.
Now, this is a collection of reports from Marathon Asset Management, which is a very successful firm known for its long-term investment strategies. So they've been around the block, they've seen a few things, and they've got a pretty interesting perspective on how markets work.
Yeah, what I think is really interesting about Marathon's approach is they're not just looking at numbers.
Yeah.
They look at industries through this lens of human behavior and incentives, and they recognize that that these things really play a huge role in how capital flows and ultimately where the returns are found.
So it's not just about supply and demand, but almost like the human element that's driving those forces.
Exact.
Interesting. So to illustrate this, the book opens up with a fictional example.
Yeah.
And this fictional example is about a widget manufacturer called Macro Industries.
Okay.
Now, Macro Industries, they start out very successful, right?
They do. Yeah, initially Macro Industries is just thriving.
Yeah.
Profits are soaring. The CEO, he's a media darling. And all the analysts on Wall Street are predicting, continued growth. It's the classic picture of a booming industry.
So what happens then? Where does it go wrong? Does the human element start to creep in?
Exactly. So the CEO, influenced by all this positive tension and maybe a little bit incentivized by stock options, decides to drastically expand the business. New factories, more equipment, you name it. It's all happening.
Full steam ahead.
And of course, the investment banks are right there, eager to help finance this growth. I mean, they profit from underwriting these large expansions.
Everyone's getting rich.
Everyone's happy. Everybody thinks the music's going to play forever.
Everyone's caught up in this hype. Nobody's thinking about what could go wrong.
Yeah, and this is what they call competition neglect.
Okay.
Where, businesses just fail to consider what their competitors are doing.
Yeah.
And this is a huge driver of the capital cycle.
It's like they're all looking at their own little maps, but they're ignoring the larger terrain.
Exactly.
So what happens next in the macro industry story?
Well, fast forward 5 years.
Yeah.
And the picture is completely different. The market's flooded with widgets. Demand has fallen way short of those rosy projections.
Oh, wow.
New competitors have emerged, and Macro Industries is drowning in unsold inventory, and their stock prices plummeted.
So the boom sets the stage for the bust, I guess you could say.
That's it.
It's like the capital cycle is all about understanding these ebbs and flows.
It is. And, the book actually has this really helpful chart. It's chart 1.1, I think. And it visually represents these different phases of the capital cycle.
Okay.
And you can really see how investor sentiment and capital allocation swing from, this exuberance to despair and back again.
That's fascinating. So this chart almost acts like a tool for potential investors to look at and think about.
Yeah, and one of the things that I think they emphasize is that the best time to invest in a sector is often when it's out of favor. When everyone says running away, that's often when the groundwork for the next boom is being laid.
So kind of a contrarian approach, looking where nobody else is looking.
Exactly.
Very interesting. The book also talks about some of the psychological factors, I guess you could say, behind these poor capital allocation decisions. One of the things they mentioned is competition neglect. We talked about that a little bit. But there's also this idea of the inside view, which they highlight during the telecoms bubble. Do you know much about that?
Yeah, so the inside view is this tendency to focus on your own specific circumstances and plans when you're making a decision.
Right.
And you kind of neglect the base rates or the historical probabilities of success. So, like in the telecoms bubble, companies were making these huge investments in fiber optic cables based on their own projections of, future demand. But they completely ignored the fact that, historically, these kinds of infrastructure build-outs had often led to overcapacity and price wars.
So they were looking at their own business plan in a vacuum and not thinking about what had happened to similar companies in the past.
Exactly. They were too focused on their own story.
Gotcha. So it's like they were so optimistic about their own little world that they forgot to look at the bigger picture.
Exactly.
Fascinating. The book also digs into how misaligned incentives play into this whole cycle. We talked about the CEO of Macro Industries being incentivized by stock options, but this goes much deeper, right?
It does. CEOs, they're often rewarded for short-term growth.
Yeah.
Even if those decisions, they end up hurting the company in the long run.
It's like they're being rewarded for repeating the Macro Industries story, almost.
It is. And, one striking statistic from the book is that despite companies, plowing back most of their profits, U.S. corporate earnings have actually grown slower than the overall economy for decades.
Wow, that is striking.
Yeah, and it just suggests that, capital isn't always being allocated efficiently.
So it seems like understanding the capital cycle is not only about spotting opportunities, but it's also about avoiding potentially disastrous investments.
Right.
It's like two sides of the same coin. Are there any stories in the book about companies or individuals who have managed to successfully navigate this cycle?
There are. The book actually highlights several case studies, and one of the most compelling is the story of Bjorn Wahlroos, who was the CEO of this Finnish financial firm called Sampo.
Okay, let's hear about Sampo. What did they do differently? So this Bjorn Wahlroos, he understood the capital cycle. How did that play out in his strategy for Sampo?
Well, he took a very disciplined approach and kind of contrarian, He really focused on understanding the capital cycle within the Nordic insurance market. And instead of just chasing growth at any cost, he actually sold assets when they were overvalued. And then you would use the proceeds to buy back Sampo shares when they were cheap.
So like the classic buy low, sell high?
Yeah, exactly. But he was doing it based on, this deeper understanding of where he thought the insurance market was in its cycle.
So he wasn't just timing the market, he was understanding where the market was going to go.
Right. And it paid off big time, especially during the 2008 financial crisis. When a lot of other firms were struggling, Sampo was actually well positioned to weather the storm and even capitalize on the downturn.
So he was ready for it.
Wow. That's a really powerful example of how understanding the capital cycle can lead to some incredible results. But the book also looks at some cautionary tales, right?
Yeah.
You mentioned Anglo-Irish Bank earlier.
Yeah.
What can we learn from their story?
Oh, Anglo-Irish is a stark example of what can happen when you ignore the capital cycle. They were heavily exposed to the Irish property market. They were extending loans at a rapid pace, fueled by cheap debt and, these overly optimistic projections.
That's familiar.
Yeah, and Marathon Asset Management actually had a series of meetings with the bank back in the early 2000s, and they noticed some red flags.
Like what kind of red flags?
Well, they observed this really aggressive, promotional culture.
Yeah.
And this heavy reliance on a single booming market for their growth. So they were basically putting all their eggs in one basket.
Yeah, and they also kind of noticed this whiff of Ponzi finance, as they called it in the bank's lending practices.
Ponzi finance? That's never good.
No, it's not.
Ah.
But Anglo-Irish was caught up in this fervor of the property boom, and they seemed totally blind to the risks.
So they were betting everything on this one sector, and when that sector turned, it all came crashing down.
Yeah, when the global financial crisis hit in 2008, the Irish property bubble burst, and Anglo-Irish was left holding billions of euros in bad loans.
Oh.
And ultimately, they had to be nationalized by the Irish government just to prevent a complete collapse of the banking system.
Wow, that's a really sobering example of how ignoring the capital cycle can lead to some disastrous consequences. One more thing I wanted to touch on that the book kind of delves into is the impact of prolonged low interest rates on the capital cycle.
Yeah, that's an interesting one, because you would think that low interest rates would be good for business, right?
It makes sense to me.
But the book argues that these extended periods of low interest rates can actually create all sorts of distortions in the capital cycle, and they might actually hinder healthy economic growth in the long run.
So low interest rates are not always a good thing.
Not necessarily. One of the problems is that they can keep zombie companies afloat.
Zombie companies? That sounds scary.
They are, in a way. These are businesses that would typically fail in a normal economic environment, but they're able to survive because of the availability of cheap debt.
So they're kind of like the walking dead of the business world.
Exactly. And their presence can prevent healthy consolidation within industries. It's like delaying a forest fire that would naturally clear out the dead wood and make room for new growth.
So these zombie companies are kind of clogging up the system.
They are.
Yeah.
And this can lead to prolonged overcapacity in certain sectors. It hinders innovation and productivity growth.
I see. So low interest rates, while intended to stimulate growth, can sometimes have these unintended negative consequences.
They can. It's a very nuanced issue, and it's one that's particularly relevant in today's economic environment.
It is for sure. Speaking of specific markets, the book also has a section on China, and they talk about this idea of the China syndrome.
Right. Marathon Asset Management has historically been very cautious about investing in China, and their reasoning stems from a deep understanding of how capital is allocated in that market.
Okay, so what makes China different in this context?
Well, a lot of China's economic growth has been fueled by massive government-directed investment.
Right.
And while that's led to some impressive headline growth numbers, it also raises concerns about the efficiency of capital allocation.
So the concern is that the government's involvement might be distorting the natural workings of the capital cycle.
Exactly. When the government is directing investments, they're not always guided by market forces or the pursuit of the highest returns.
I see. So it's like they're picking winners and losers,
Yeah.
which might not always be the best approach in the long run.
Right. And this can lead to overinvestment in certain sectors and misallocation of resources, potentially creating bubbles and inefficiencies.
So even in a rapidly growing market like China, understanding the capital cycle and being aware of potential distortions is really crucial for investors.
Absolutely.
It sounds like Marathon has been pretty skeptical of China for quite some time. Have they ever invested there?
They have, though, very selectively and always with a cautious approach. Interestingly, the book details one instance where their skepticism of the Chinese market proved to be unfounded.
Oh, really?
Yeah. They were initially wary of a Chinese insurer called PICC that went public back in 2003.
Okay.
But ultimately, that skepticism turned out to be misplaced. PICC actually ended up performing quite well.
So even the experts can get it wrong sometimes.
It happens.
Right.
But it's a good reminder that, no one has a perfect crystal ball. And even when you have a deep understanding of the capital cycle, there are always going to be surprises.
That's true. So for our listeners out there, this all seems very high level, focused on these large-scale investments and macroeconomic trends.
Right.
How can we start to apply this knowledge to our own lives?
That's a great question. And it's something that the book touches on as well. While capital returns primarily focuses on large-scale capital flows, the authors argue that these core principles of the capital cycle can actually be applied on a much smaller scale.
Okay. I'm intrigued. How so?
Well, think about your own career, for example. Are you investing in your skills and knowledge when others are complacent? Or are you waiting for everyone else to jump on board before you make a move?
I've never thought about it like that.
Yeah. Are you positioning yourself to benefit from the next boom cycle in your industry?
That's a really interesting way to frame it. It's like we each have our own personal capital cycles to navigate.
Exactly.
Yeah.
And the same principles apply. By understanding, the recyclical nature of your industry, identifying areas of overinvestment and underinvestment, you can make these strategic decisions about your own skills and career path and really position yourself for greater success.
Wow, you've just given me a whole new perspective on career planning. It's not just about following your passion, it's also about understanding these broader forces that are at play.
Right.
And making smart choices based on where you are in your own personal capital cycle. Are there any other ways that this concept could be applied on an individual level?
Definitely. The principles of the capital cycle can also be applied to personal finances. Like, think about things like buying a house or investing in the stock market. Are you buying when everyone else is buying at the peak of the market? Or are you looking for opportunities when sentiment is low and assets are undervalued?
So it's that same contrarian mindset, looking for value where others are fearful.
Exactly.
Yeah.
And that doesn't mean going against the grain just for the sake of it. It's about understanding these cyclical forces that are at play,
Right.
Identifying opportunities that others might miss, and then making informed decisions based on your own individual circumstances and goals.
This has been so insightful. It seems like understanding the capital cycle isn't just for Wall Street investors.
It's not.
It's a valuable tool for anyone who wants to make smarter decisions in their career, their finances, and even just their life in general.
It is.
Yeah.
And one other thing I wanted to mention is that the book also highlights this important element of the capital cycle that's often overlooked, and that's the role of Wall Street.
Okay, tell me more about that.
Well, the authors introduced this recurring character in Capital Returns named Stanley Chern.
Okay.
And he's this investment banker. He's fictional, but he offers this really cynical but often insightful perspective on how Wall Street operates.
So he's like the voice of Wall Street cynicism.
Yeah, exactly.
Yeah.
He's always looking for the next big score. He's always trying to exploit the system.
So how does he fit into the whole capital cycle story?
Well, he embodies this short-term, fee-driven mentality that can sometimes really distort the capital cycle. He's always on the lookout for ways to exploit market inefficiencies or manipulate situations to his advantage.
So he's not really playing the long game.
No, not at all. He's all about generating fees for himself and his firm. And he's constantly coming up with new schemes to do so.
The book mentions one example where he's pushing for something called Rearview 7th Supersize. What was that all about?
It sounds like some kind of mega buyout fund designed to extract maximum value from companies, regardless of the long-term impact.
So like a classic private equity play.
Yeah, exactly. And, the book uses Stanley's character to really highlight the potential downsides of this approach.
Yeah.
While private equity can play a role in the capital cycle, There's always this risk that it becomes too focused on financial engineering rather than genuine value creation.
It's all about the quick buck.
Exactly.
So it's a reminder that while understanding the capital cycle is essential, you also need to be aware of the players who might be trying to manipulate it for their own benefit.
Absolutely. You need to be a savvy investor and a bit of a detective.
I like that. A capital cycle detective.
Yeah, you need to be able to spot the red flags, to question assumptions, and to look beyond the hype to see what's really driving the numbers.
So how do we become better capital cycle detectives?
Well, it starts with education. Reading books like Capital Returns is a great first step. It's about developing a deeper understanding of how markets work, how capital flows, and how human behavior influences these cycles.
So it's about seeing beyond the headlines and understanding the underlying forces at play.
Exactly. And it's about being willing to challenge conventional wisdom, to think for yourself, and to be skeptical of easy answers.
It sounds like understanding the capital cycle is not just about making money.
It's not.
It's about developing a more informed and nuanced perspective on the world.
It is. It's about recognizing that things are rarely as simple as they seem, that there are always cycles at play, and that understanding those cycles can give you a significant advantage in navigating the complexities of the financial world and beyond.
Well, this has been an incredible deep dive into the world of capital cycles. I feel like I've gained a whole new perspective on how the financial world works and how those principles can be applied to other areas of life as well.
I'm glad to hear that.
Yeah.
And I hope our listeners have found this conversation as insightful as I have.
I'm sure they have.
Yeah.
Is there anything else you'd like to add before we wrap up?
Just that Capital Returns is a book that I highly recommend to anyone who wants to gain a deeper understanding of the forces that shape the financial world. It's a thought-provoking and insightful read that can help you make more informed decisions in all areas of your life.
I completely agree. Well, thank you so much for joining me on this deep dive into capital returns. It's been a pleasure exploring this topic with you.
The pleasure was all mine.
And to our listeners, we encourage you to check out the show notes for more resources and links to the source material. Until next time, keep exploring, keep learning, and keep diving deep. We were talking about Stanley Chern, that fictional investment banker you mentioned from Capital Returns. He really just seemed to be laser focused on that short-term gain, always looking for the next big score.
Yeah, he really embodies that short-term, fee-driven mentality.
Yeah.
Which can sometimes distort the capital cycle. I mean, he's always looking for a way to exploit, market inefficiencies or manipulate situations to his advantage.
Yeah, the book gave that example of rear-view cities of supersize. What was that all about?
Well, it sounds like, just a classic private equity play, where these large buyout funds come in, they load companies up with debt extract value, and then try to flip them to some unsuspecting buyer.
So not a lot of concern for the long-term health of these companies.
Not really. He's very focused on those short-term gains.
Mm-hmm.
And, the book uses his character to kind of highlight the potential downsides of this approach.
Mm-hmm.
Right? While private equity can play a role in the capital cycle, there's always a risk that it becomes too focused on, financial engineering instead of genuine value creation.
Right. It's all about that quick buck.
That's it.
So it's like understanding the capital cycle is important, but you also have to be aware of the players who might be trying to manipulate it for their own benefit.
Exactly.
It's like you need to be a savvy investor, but also kind of a detective.
You got it. You need to be able to spot the red flags, question assumptions, look beyond the hype, see what's really driving the numbers.
So how do we become better capital cycle detectives?
Well, I think it starts with education. Reading books like Capital Returns is a great place to start. Developing a deeper understanding in how markets work, how capital flows, how human behavior influences these cycles.
So it's about seeing beyond the headlines and understanding those underlying forces at play.
Exactly. And then also being willing to challenge, conventional wisdom. Think for yourself. Be skeptical of easy answers.
It sounds like understanding the capital cycle isn't just about making money. It's really about developing a more informed and nuanced view of the world.
It is. Recognizing that things are rarely as simple as they seem, that there are always these cycles at play, and that understanding those cycles can give you a significant advantage in navigating the complexities of the financial world and beyond.
Well, this has been an incredible deep dive into the world of capital cycles. I feel like I've gained a whole new perspective on how the financial world works and how those principles can be applied to other areas of life.
I'm glad to hear that. And I hope our listeners, got something out of it too.
I'm sure they did.
Yeah.
Before we wrap up, is there anything else you would like to add?
Capital Returns is a book I'd highly recommend to anyone who wants to gain a deeper understanding of, the forces that shape the financial world. It's a thought-provoking, insightful read that can really help you make more informed decisions in all areas of your life.
I completely agree. Well, thank you so much for joining me on this deep dive into capital returns. It's been a pleasure exploring this topic with you.
It's been a pleasure.
And to our listeners, we encourage you to check out the show notes for more resources and links to the source material. Until next time, keep exploring, keep learning, and keep diving deep.